Hi, everybody, and apologies for the slight delay. We were just having a little bit of a tech glitch, but we're all set now, and we're very happy to have Harish Krishnan with us in our second masterclass on factor investing. Harish is a senior fund manager and at Kotak Mutual Fund, and he's also one of India's top ranked fund managers. He's been investing for almost 2 decades in the Indian stock market now. He's an MBA from IIM Kozhikode. He's a CFA and done his engineering from GEC Trichur. With that, over to you, Harish, if you want to make some opening comments about the topic that you've chosen for today, and then we can put up the slides and start from there.
Sure. Thanks, Anish, and apologies for the tech snafu at our end. But it's a great privilege and honor to be part of this. And the idea of today's session was actually one of the many threads that I think you put out on Twitter in terms of fundamentals and quant, and there was this series of threads that went on in terms of what are the key differences or what are the key benefits of for a fundamental investor to use on quant. And I had expanded some of my thoughts at that point of time, which were very primitive on that feed. But then I thought, having this conversation with you will set a decent foundation wherein I can upset both the purist and both the dimensions of both quantitative investing as well as fundamental investing. So I'm up here for the challenge to do that, and can start off the slide deck whenever you're ready, Anish.
Yeah, I mean, just like you, I come from a fundamental background, and crossing over to the dark side, and it reminds me of that song by REM, "Changing Your Religion." So it's a bit like that. Both sides feel that you have, but as I've learned that I understand where my friends on the fundamental side come from, and I also understand now where my friends on the quant side come from. So either it's the best of both worlds, or it's the worst of both worlds, however you want to put it. But I'll just start your slide.
So in some sense, we are partners in crime, attempting to offend as many people as we can in the next hour or so.
Correct.
Connected.
Correct.
Okay. I have the.
You want to join from your laptop?
If I don't know, now I'm all confused. Okay, let me. Is it possible that I can join from the laptop, or is it going to take too much time then?
No. You can just drop off from the. I'll just add you.
Okay, so we're good to start. Anish, I'm just checking whether I'm audible, and then
yes, you're audible.
Okay, great, thank you. So, like I said, the idea of today's discussion was how we look here at Kotak, wearing both the hats. Obviously, we've decent amount of track record in running a fundamental shop in at Kotak Mutual Fund, and over the course of the last 5-7 years, we've tried to embrace quant, both from a aspect of pure quant of factors, as well as in terms of helping the practitioners on the fundamental side. And I'll delve into both of them, and I'll try and kind of nuance as to where I see a lot of similarities, and I'll also try and bring out where I see the key differences and how we're trying to marry the best of both, if I may. The next slide, please. So this really is the problem statement that we have, right? And we all know about the active versus passive debate, but broadly there are three dimensions in the form of any strategy. You've got the proprietary or an insight, if I can use that word. In the case of active, of course, it is proprietary to how the fundamental research, etc., comes out, and therefore there is a proprietariness out of it. The second dimension is that of repeatability, which is that should the markets or should the environment present itself with a similar kind of a background, would the outcomes would be as repeatable as what it were in the test setting. And the third dimension, of course, and which is the much debated one out there, which is in terms of cost, that all of these have to have a cost, and whether it will kind of make it through. And if you really look at from an active lens, which is the traditional fundamental hat that a lot of us wear, the insights are definitely a lot more proprietary. Unfortunately, a lot of these insights come up with their own biases, which is where I think that the repeatability quotient reduces quite dramatically. So one may claim that one is a value investor, but in an environment when value does well, do you necessarily kind of perform at that point of time, so that at least the pain of not performing during a phase when value possibly didn't do well kind of gets made up? And that's really the repeatability aspect that I'm speaking about. Cost, of course, clearly on the active side, that is generally tends to be on the higher side compared to where it is now. Coming to the passive side, if you were to look at each of these dimensions, if you click once, Anish, uh, so clearly on the passive side, especially out in India, most of the passive strategies have zero proprietary insights. Most of them are typically basis public indices, which are very well outlined in terms of the rules that they follow, the various cutoffs. Most of them invariably tend to be market cap size driven as their primary aspect. Invariably, when we look at pure passive, ultimately it boils down to cost as the single largest determinant. So on the negative side, I would think that there are some significant liquidity constraints, and I've spoken about this before as well. That whenever we're looking at passive or rule-based funds, clearly, given the fact that India is not a very deep market in terms of number of securities, wherein one can execute a lot of trades on. I would think that liquidity is definitely an issue. Also, the issue is that if they're all basis public indices, then the impact cost of all of these strategies getting rebalanced on the same day tends to be much higher. And therefore, there is that issue. And of course, without getting into the names, we've seen, for example, in the past, we have had issues on reputation, in the sense that many firms, kind of rig the rules process, and any process wherein the rules are very transparent, I would think that there is enough incentive for everybody to get into that through various ways, and which means that the reputation of a lot of these indices on is something which is on the gray side. So this broadly is the problem statement that we have, that we've got some good attributes on the pure active side, which is primarily fundamental driven, and some good aspects on the passive side. And therefore, can we combine both of them is what we are seeking out over the course of the next 30-40 minutes or so. The next slide, please. So at here in Kotak, we've kind of embarked on using quants to kind of address both of these aspects that I spoke about on each of these dimensions. The proprietariness of insights, which means that private quant rather than public indices, the repeatability aspect, and of course cost is any which case an aspect that will come through when a lot of these strategies go live, etc. But broadly, we look at using quants in two different dimensions. One, what we call as quant assisted fundamentals. Now, here the idea is that we continue to run a lot of our strategies on the way we used to run, but we provide feedback loops of what Mr. Market is telling us in a way to assess risk that is there in the market. And this is something that we've kind of helped run some of our asset allocation strategies, I would say, with reasonably okayish or good track record, using a lot of these feedback loops to try and help the overall decision making of the fund manager. The fund manager still has got the powers to finally pull the trigger. They can choose to override these signals that come through. But in many cases, when we give this collective wisdom of the markets and the feedback loops, typically over a period of time, we've generally seen a lot of fund managers and the analyst side actually openly embracing a lot of these feedback loops. So this is the quant assisted fundamentals. The second sleeve that we have is the fundamentally assisted quant. And Anish, if you can click once more, please. This is basically, the traditional factor indices, etc., which is basically using the power of compute to arrive at portfolios with minimal human intervention. But the idea is clearly that can we use the experience of the fundamental managers to arrive at the edge cases and the boundary conditions to help in reducing the reputation risk that I spoke about in the previous slide, and also to arrive at when to rebalance. And these are all areas which are in the gray. So this is where we kind of use the benefit of experience, but eventually let the power of compute to arrive at the final shape and of the portfolios. The last thing that we look at, and Anish, if you can click once again, please, is primarily to look at alternate data. And that is when it comes to India, of course, we are starting to get data rich. Of course, a lot of data in India is still very primitive. We don't really have a very rich data like say, for example, the US, etc. But we're getting there, wherein a lot of data, especially as far as, say, the public goods infrastructure is concerned, is starting to come on board. And therefore, we think that even for fundamental research, this is something that we can benefit by harnessing a lot of these alternate data, rather than looking purely from the lens of company balance sheets and company interactions, to try and get greater evidence of our investment thesis. So this is broadly the big umbrella under which we use quant across the length and breadth at Kotak Mutual Fund. The next slide, please. So this is something that we all do understand, that investing is a probabilistic endeavor. And while we all have a back test, we all have a track record, etc., of the past 5 years, past 10 years, etc. The reality is that it is just one instance of how reality has played out. It could have been a whole set of other interdependent variables that could have been in play, which could have meant a different starting point now than what we are currently seeing. And therefore, a lot of our work goes into in the form of probabilistic thinking. And therefore, how do we improve our decision making, given the inherent nature of probabilistic endeavor that we are setting ourselves on? And therefore, this kind of sets up as one of our key cornerstones in terms of our thinking of devising a quant bottoms up from first principles level. Next slide, please. So yeah, this is what the last three slides are pretty much the prelude of the problem statement and how we're looking at it from a philosophy point of view. What I would now want to focus on is to try and upset both the camps. By trying to bring out the positives and negatives of both fundamental as well as quant investing, and hopefully do a reasonably good job in offending both camps. Next slide, please. So the reality is, minority investors need to act on very incomplete information. Unlike, say, the promoters who also don't have all the information, but who got reasonably, or who are possibly in the best position in terms of ability to get information. We, sitting as minority investors, typically are far removed from where they are. Which means that we need to decide on a go, no go, invest, no invest, with slightly lesser information. Now, the starting point of all our information is, of course, public disclosures. And thankfully, the regulators have kind of made a lot of disclosures happen quite seamlessly. Of course, there are some positives and negatives. There are now maybe a bit too much of noise also coming through, but I think this is the starting point of any analysis, be it that of quant or be that of fundamental research. And over here, clearly, it is Google Zindabad. Next slide. Next, please. And the next level of what we have is basically the information edge. Now, having got all of this public disclosure, running our screeners, whatnot, we want to embellish our investment thesis by either the traditional approach, which is the channel checks or management interactions. Again, I'm speaking about from a legal point of view. We are not talking about insider information, etc., but purely from a legal, ethical point of view. Whatever we can through the traditional sources of interactions is where our the next assessment comes through, which is in terms of the information edge. The subsequent assessment is clearly coming through. Anish, can you click? Is the diligence edge, which is basically having got all of this information, how are we looking at pattern seeking? And over here, I am of the firm belief that a lot of us actually go deep down into the problem. And while that is definitely important, in many cases, the bundling approach or synthesis approach actually is a far more powerful, wherein one can be able to get a lot more higher dimension or higher power pattern seeking, which can help in terms of overall decision making, given the fact that we are working with limited information. The next edge is clearly that of behavioral. Now, over here, idea is to look at the market feedback loops. It could be in terms of the wisdom of the crowd, in terms of, say, market feedbacks, in terms of price feedbacks, etc. Or it could be in the form of, somebody whom we all respect, and we take their counsel in terms of bouncing off ideas. Or more importantly, it is about knowing oneself, and therefore knowing when not to do anything, right? So this really sets up for our various stages of getting information, be it that as a fundamental investor, or through that of the lens of quant, in whatever way. Or at the end of the day, I would think that most of the decision making that we'll end up doing would be happening when we have maybe anywhere between 65 to 70% of information. Rough thumb rule, again, there is no right or wrong out of this. I would say is that 50%, up to 50%, we'll get from the internet and Google, and you can use all kinds of machine learning, NLP, etc. But to go from 50 to 65 to 70 is where the diligence and whatever information signal that we are looking at, which is proprietary to us, that is going to help us getting there. And then to have an entire risk management framework to try and do a decision at 65 to 70% of all available information. So this is broadly the lay of the land in terms of how investors, be that on the fundamental side or on the quant side, kind of think about. The next slide, please. Now, if you look at any portfolio manager, and maybe Anish, you can just start out with all the buttons instead of animation. It'll be easier for you. So broadly, there are four buckets, of any portfolio manager that we have, right? You've got the buy, which is primarily focused on mispricing. You think that that is something that the market is missing out, or you think that the business can potentially do something else, be it in terms of earnings surprise, or in terms of markets misassessing, or a catalyst or a trigger that is likely to come through over the course of the next 12 to 18 months. And therefore, a lot of our focus invariably focuses on the buy side, on the buy signal, which is a key attribute of most portfolio managers. The second key decision that we look at is where do we park most of our reinvested profits back into compounding machines, which can continue to compound capital and give us market beta, to put it in the lens of of a quant. This is where most of our capital is there will be some amount of capital which is into the buy zone, which is primarily coming out of mispricing. But most of the time, we get back into this zone, which gives us market beta, which is on the reinvestment zone. Then comes the selling decision, which at least I have learned out is mostly filled with regrets. You've got either the regret of having sold too early, or you've got the regret of not having sold at the right time. And as most practitioners have kind of explained, this is more an art than science. And this is where I think quant can play a big role. So recently, I think we had posted on various feeds on the importance of selling, and there was this very interesting paper wherein they looked at almost I think about 16 years of data of professional managers, close to about 4.2 million decisions of buying and selling. And basis those decisions, it is quite clear that while most fundamental investors are very good at buy decisions, we get quite lousy when it comes to the sell decisions. And which is where I would think that a significant amount of positive feedback loops coming through quant can actually help quite significantly in terms of overall decision making. And the last decision is, of course, having got all of this information, having met companies, having realized that this is worth investing in, etc. How do you kind of weigh them in terms of constructing that overall portfolio? Clearly, a lot of focus is on investing stocks, etc. But I would say definitely that portfolio construction is actually underrated, and therefore a significant amount of weighing schema importance is needed. And then there is the frequent rebalancing that comes through in terms of how we look at. So this is broadly 101, be that of a fundamental investor and to a certain extent even in the quant world. Next slide, please. Anish, the next slide, please. I think you're
I'm
frozen.
already on the next slide, which is the fundamental quant. How do they stack up? Can you see it?
Okay. I don't know. I'm still seeing it as the previous slide.
I've moved on to the next one. Okay, let me just remove and add it again.
Sure.
Can you see it now?
There's no slide at my end, at least. I don't know the issues at my end. Or can I try and presenting it from my end?
Yeah, if you have if you can present from your end, I think that should also work.
Okay. Let me. Is the presentation visible?
Yes.
Okay. So sorry about this.
You can just go full screen and
Yeah, it's is the next slide visible? Fundamental or quant, how they stack up? Anish?
yeah, no, I can see the decision making of any portfolio manager.
Is it visible now or it's still the same?
No, it's still the same. I don't know why that particular slide is getting stuck.
Ah,
Yeah. Now it's there.
okay.
Yeah.
It's visible now?
Yes.
Okay. Sorry about this. So essentially on these
You
four
can,
dimensions,
you
if
can
you
just
were
go
to,
full screen so that everybody can see.
yeah, I have put
You
it on.
just okay. Great.
Has it shown through?
Not yet. Maybe a little bit of a lag. It's gone again.
Ah, Is it visible? Anish, is it
Yeah,
visible
yeah, yes.
in the full screen mode?
No, but I think let's just
Okay.
start
Okay.
so that.
Yeah. So essentially, if you were to look at it on either the fundamental side or the quant side, on each of these four dimensions, if I were to look at how they kind of placed, uh, as far as on the fundamental side, buy heuristics are typically on the past data and the individual assessment of the future. And past data patterns, is very similar to what we do in quant or factors. uh, I would say that there is a whole lot of similarity. Whereas when we look at quant side, the buy heuristics are primarily looking at past data and wisdom of crowds. So instead of the individual assessment that we have in terms of, say, management interaction, etc., we are looking at the wisdom of crowds, and it could be, say, the momentum signal, it could be some other intelligence, maybe the drawdown features of the stock. It could be clustering of stocks that we look at, or clustering of sectors, etc., by which we get the wisdom of the crowds. And I think the on the buy side, on the buying signal side, both fundamental and quant are pretty much up there. It's just that the signal nuance might be slightly different in the case of quant as against fundamental, wherein a lot of focus is typically given in terms of interaction of management. Coming to the diligence edge, I think this is where fundamental really scores high up, which is basically that, maybe because of career risk, because of the reputational points, etc. There is a very, very high focus on not get on getting or on not investing in a company which may have, say, questionable corporate governance, which may have a reasonably higher drawdown compared to the rest of the market, etc., which means that the focus is to reduce errors of commission. Obviously, when we tend to focus more there, I think there's a good chance that you also have a reasonably higher chance that we may miss out on something. But by and large, I would say that the diligence edge is where fundamental really scores a lot higher than on the quant side. On the quant side, of course, we do have approaches, like I said, the wisdom of the crowd, etc. We also run a whole bunch of forensic kind of data, in terms of identifying which are the names which are likely manipulated in terms of account statements, etc. But I would say that, basis my experience, the diligence edge provided on the fundamental side is a far more superior kind of an input than what comes out from any quant signal that we've kind of worked on. Coming to the third aspect, which is reinvestment. Now, typically, when we look at reinvestment, one of the key factors that we look at from a fundamental point of view is that what is out of sight goes very much out of mind. And again, coming back to the same paper that I discussed, once you sell out of a particular position, the chances are that you are unlikely to get back into that position for a reasonably long period of time. And that is where the biases, etc., come through, which means that many positions are retained, even if their underlying thesis or the underlying signal is kind of gotten stale or not valid in the near term, purely as a parking lot or to ensure that they continue to remain tracked. And which is where I would say it's one of the shortcomings of on the fundamental side. Whereas if you look at from a quant lens, generally, what we keep in the reinvestment bucket typically retains a reasonable amount of signal. It could be whatever signal that we are harvesting, it could be value, it could be momentum, quality, etc. Or at least we ensure that it is not at the bottom of the signal. And therefore, I would say that the overall signal harvesting is a lot more efficient out there. Now, coming to the selling dimension, here clearly quant scores significantly in my view. Clearly, decisions tend to be unbiased if the signal is not there or if it is at the bottom, etc. There are clear rules as to when one will sell. Of course, it does come through with the prospect of higher churn. but at least it becomes very unbiased. And given the literature that I spoke about, wherein a significant amount of alpha is lost on the fundamental side because of the selling indiscipline, I think this is where Quant really scores very high up, more than anything else. On the fundamental side, it's typically a regret of either selling too early or too late. It's always an art. There are significant amount of biases that creep in. The last key difference that I can think of is clearly that it's an asynchronous rebalance cycle as far as fundamental is concerned. You don't change the entire portfolio on one rebalance date. As and when some information comes through, you rebalance, etc., and therefore the clock becomes asynchronous. Whereas if you look at from the lens of the quant side, it's a very synchronous rebalance cycle, which means at any given day, whenever we choose to rebalance, the entire universe is the signal is harvested of the entire universe, and therefore it's a synchronous. Now, personally, I don't know whether being a synchronous rebalance cycle is beneficial to an asynchronous one, but clearly from a bias point of view, I would say asynchronous is much better. However, it does mean that it induces a significantly higher amount of churn compared to what a fundamental based strategy is. So these are broadly, I would say, on those four key dimensions that I spoke about, how both fundamental and quant stack up. Now, again, if you were to look at some of the attributes of each of these characteristics, so if you look at purely from a hit rate perspective, and I'll speak about hit rate in the next slide, is basically the percentage of the portfolio that outperforms over the next 60 or next 120 or trading days, which is basically the next quarter or the next 6 months. Generally, we have seen, and when we look at our own attribution on the fundamental side, it tends to be better. But it's not that we are talking of significantly better numbers. We are talking about 3-4 percentage points better than what it is in when we look at quant strategies. On quant, what we've generally seen is that the near-term hit rates almost of all strategies tend to gravitate towards 50. In fact, a lot of strategies, it's even lower than 50%. What that means is that if you have a particular portfolio on rebalance, and till the next rebalance or till the next 60 days, trading days, you keep the same portfolio, what percentage of the portfolio actually outperforms that benchmark? It could be, say, NSE 200, NSE 500, what you have. And what we've generally seen is that the median hit rate, obviously, it's a noisy variable, right? There are times and there are quarters wherein 70, 80, 90% outperform. There are times when it's 20, 30%. But when we look at the median hit rates over, say, last 15 years, 20 years of that particular strategy, invariably they tend to be gravitated closer to about 50%, which is what our evidence across various strategies seem to suggest. When I look at the attribution of returns, and here I want to introduce this concept of hindsight best and hindsight worst. What we mean by hindsight best and hindsight worst is on any two rebalance, or let's say that we are running a quarterly rebalance between one quarter and the next quarter, and let's say that out of a universe of, say, the top 200 companies, we have to pick the top quartile or the top quintile, what you have. So you on a hindsight basis, you will know exactly and equal weighted the best stocks that have outperformed in each quarter, and then they'll keep skipping. So every quarter there'll be a new set of stocks that come through, right? So that's the hindsight best portfolio. Obviously, it'll have phenomenal returns, but it's a hypothetical portfolio in that sense, right? Nobody will get all of their things in the hindsight best. Similarly, if you were completely unfortunate and you chose the hindsight worst, you would get the hindsight worst portfolio, which will erode value very, very quickly, reasonably fast. So these are the two boundaries at any point of time, right? And then we start to see what percentage of the portfolio was in the hindsight best and what percentage of portfolio was in the hindsight worst over cycles, right? And what we've seen in as far as the fundamental portfolios are concerned are that they are more evenly distributed. So if I were to take the same example, if I'm looking at, say, 200 stocks, out of which I have to choose 40, it's basically the hindsight best has got 40 by 200 probability. The hindsight worst has also got a 1/5 probability, and the balance is the 3/5 probability, right? Now, typically, the fundamental oriented portfolios will follow a similar kind of a pattern, wherein 1/5 is likely to be in the hindsight best, 3/5 in the middling portfolio, and 1/5 in the hindsight worst. Generally, again, maybe I'm overgeneralizing, which is where I would think a lot of fundamental investors would get angry. But across whatever we've studied, we've generally seen a far more even distribution of portfolio across each of these three dimensions. Whereas when we look at quant, we generally see the tail shares to be much higher. And that I would think is a very good measure whether your quant strategy is likely to be more repeatable than otherwise. If you tend to have a greater share of portfolio in the hindsight best that it's been able to identify, and a lesser portion of the portfolio in the hindsight worst. And that is where I would think that quant typically scores a lot better on compared to on the fundamental side. If I look at a long only side, and we are long only investors, so I don't have too much experience on the long short side, but typically if I were to look at market beta on the fundamental side, and there's a lot of research, I think Anish, Rajan, etc. have published a lot of it, clearly do seem to suggest that there's a lot of market beta in terms of fundamental oriented strategies. And in quant, of course, the majority is still market beta. 60, 70, 80% would still tend to be market beta, market factor. But a whole bunch of other factors also start seeping in, obviously, depending on what the strategy is all about. And therefore, you do tend to get slightly better exposures than purely just the market beta when we look at quant. As far as churn is concerned, I think it's a no-brainer. Most quant churns tend to be higher compared to a pure fundamental oriented portfolio. As far as active shares are concerned, typically what we've seen is that fundamentally oriented investors tend to have a lower active share. Of course, in India, the problem is magnified by the fact that some of our benchmarks, especially on the larger names, tend to have a disproportionate high share of the top 10 companies in the benchmark at 50-60% of their overall index weight, which means that typically active shares tend to get a lot lower because invariably most people don't want to be completely away from these top 10 positions because they tend to be those 10 positions tend to be tracked. And therefore, the balance 40 or 50% is where most of the active share tends to be focused on. So typically, what we've seen is fundamentally oriented investors tend to have higher active share. Again, I'm nowhere saying that just because you've got a lower active share means that you would underperform, or just because you have a higher active share you would outperform. But I'm just trying to give the nuances of each of these dimensions. In the case of quant, clearly, you can get to very, very high active shares, which tend to perform. So you can go as high as maybe in 85-90% active share strategies, which can give you reasonably, you would say, differentiated portfolio compared to what your typical fundamental oriented or market cap heavy passive indices can bring through. On the clock side, I've already discussed. Like I said, I am not myself convinced whether a synchronous or an asynchronous clock is more efficient. Both of them clearly have their own pluses and minuses, but that's the way it is. Coming to the hit rates of pure quant, this is on momentum again. There's the fast, mid, and slow momentum that we've tested out. This is over the period of the last 20 odd years or 22 odd years. And clearly, when we look at the median hit rates are basically, like I said, the percentage of the portfolio that outperforms, say, NSE 500 or NSE 200, whatever be the universe. Here it is the basis the universe of 500. We are talking about median hit rates in the late 40s. It's not even in the 50% range. So that is where typically the bars are for quant strategies. Invariably, it means that you've got a lot of portfolio of a significant amount of portfolio that actually underperforms. They may not underperform totally. A lot of them are more market performers, plus or minus 2, 3, 4%. But you will also see a significant amount which is underperforming. And therefore, when you've got such low hit rates, I think it has got a lot of importance in the weighing schema, which in my mind, typically equal weighted weighing schema tends to have a far better profile, given the fact that you don't know, ex ante, which are the stocks of that 50% that is likely to outperform. And therefore, typically, I would think that, especially in strategies where hit rates are very close to 50%, an equal weighted strategy, in my opinion, typically is a much better thing than trying to bring in complexity on the weighing schema. Now, this is where I think the fundamental disconnect of equity research 101 compared to quants, which is basically that typically compounding of wealth, all of that requires time, and it's primarily predicated on the fact that companies are doing all the heavy lifting, and we are just quote unquote sponging off them by riding on their coattails, so to speak. So the management teams and the companies are doing all the heavy lifting, and we're just gliding along with them by giving our capital to them, right? And the key aspect is that of time. Now, the typical quant orientation is that we'll be able to identify the best signal at any point of time and keep skipping, and therefore, by constantly skipping, we'll be able to constantly move our capital as agile as possible, without giving the companies reasonable amount of time to perform. And this is where I think the biggest dichotomy that I personally have, wherein I genuinely do believe that time and persistence with a company is very, very important than necessarily skipping, because purely skipping from one to another has got also capacity issues, in my opinion, which can work in a small size, but not necessarily at very large sizes. So what have I plotted here? Again, I'm taking you back to the construct of the hindsight best and the hindsight worst. So broadly, this is a period of 61 rebalances from Jan of 2005 to June of 2002, and along these 61 rebalances over the 17-year kind of a time frame, if I were to look at, say, pure momentum, let's look at that, right? Totally, there are 427 stocks which were there in this 17-year period. Now, out of these 427 stocks, if you were to look at the pure momentum, which is the top 20%, top quintile momentum, pure momentum, right? Close to about 225 stocks are there between 0 to 5 rebalances, which means in a 17-year period, they are there maybe anywhere between between, say, 3 months to 1 year, or maybe 1 year and 3 months broadly, which is almost 60% of all the stocks are there for such a short period of time. They come in, they go out, and that's the end of it. But if you look at this, there are only about 25 stocks, or less than 5% of all our stocks, which are there even for only about, say, 3 to 4 years, or maybe 4 to 5 years out here, right? Which I would say is 4 to 5 years is a good enough time frame, but it's still a very small percentage of stocks which are actually being persisted for so long. Typical fundamental investors, and I have not provided that because it's proprietary, tend to be much more long tail, right? There are stocks that, for example, in our portfolios, we've held on for 8, 9, 10 years, which have compounded tremendous amount of wealth. But of course, there are long patches of underperformance as well, but we've persisted with them. And clearly, we do think that, there needs to be a trade-off between this constant skipping and the ability to provide greater persistence of portfolios, because if and clearly one of the most legendary CIOs in their farewell letter last year provided us some statistics, right? In his long tenure of close to about 25, 30 years of managing public monies in a mutual fund, there were, I think, close to about 450 or 475 total decisions in terms of stocks that he had done. And clearly, there were some stocks which had done all the heavy lifting, maybe the top 10 or the top 15 positions. But the idea was that at any point of time, only about 15 or 20 names decisions would be done in any year. Unlike a typical quant-oriented approach, wherein we tend to skip a lot, so there is a significant amount of churn, and therefore, is there a way in which we can bridge both of that? Is what I would think would be a better approach, rather than being a purist as far as quant is concerned, or being in the purest fundamental side, wherein we tend to give a lot of time to our companies. And over a time, many of these companies then tend to give market returns rather than market plus returns that we would have thought about. So it's a trade-off. But I would think this is where Quant actually scores negatively, in my view. It's also got a positive that, of course, it's unbiased, etc. But is there a way in which we can do better? Is what I'm talking about. Without getting too much, because I think we've lost a significant amount of time in the presentation snafus. This is something that I've presented before, and we've published also on this. So basically, this is random simulations, right? So at any point of time, you can take random portfolios and see the whole range of returns that they are. And what we've generally seen is market cap weighted. So let's look at only these three to start out with, right? Which is NSE 500 total returns, Nifty 50 total returns, and Nifty 100 equal weight total returns. Now, clearly, if you look at any of these strategies, be it a factor or be it the market cap weighted or even the equal weighted, they tend to be close to about 50 in terms of the median percentile in the 3 month kind of a time frame. Now, but if you were to look at the beauty of the equal weighted is that at least in the 6 month, 1 year, their percentile outperformance is actually quite high over the course of the last 20 odd years that have they been. Of course, as we move later on, they tend to drop off to the 40s and the late 30s. They're still better than the Nifty 50 total returns and the NSE 500 total returns. Of course, on the other end are strategies wherein, which really show up very, very high. Some of them obviously are at 80-90% kind of percentiles, but I would say it's more in the in the top half of the random portfolios, which means that clearly factor investing can definitely add to longer term persistence and longer term returns compared to pure market cap weighting. And maybe we can take this in Q&A in case somebody is more interested in. Coming to the fundamental side, this is an example that I just wanted to share with you. So how do we use reversion to help in sector allocation? Basically, we keep plotting the profit share of various sectors. This is over the course of the last 22 years. The blue line is the profit share of auto and auto ancillaries of profitable companies in the top 1,000. And clearly, it's a cyclical sector. It varies from, say, close to about 2.5%, goes way up to close to about 9%, right? And currently, we are at close to about, say, of course, in 2020, at COVID, it had come down to about 2.5%, 3%. And even now, we are close to about 4% of overall profits. In a cyclical sector, we think that, the chances of it to go up from a profit pool share from 2.5 to 8-9% is likely to be more closer to, say, 5-6% than coming back to 2%. So therefore, these are some of the bets that can help in terms of portfolio construct from a fundamental point of view. I'll kind of this is one of my last slides, and then we'll open up for Q&A. There's a lot of focus on risk management and Quant, and a lot of at least my discussions that I have made are primarily on can we have a risk management framework wherein we at least have some benchmark exposure. So if sector weightage is X, can we have something X plus or minus something rather than having nothing of that particular sector? Because obviously, the chances of underperformance can be very stark if that particular sector moves, etc. Conceptually, my thinking is that money managers are solving for the NCR problem. NCR problem is, the out of N balls, you are choosing R of a particular signal or of a particular color, etc. Now, typical risk management is either weighing schema, which is like if, say, a particular stock has got a 10% weight, I should at least have a 5% or a 7% or a 8%. I can move only in that particular corridor. Or, if a sector has got a particular weight, I need to be in plus or minus that. Or if there's a particular factor, it could be interest rates, it could be any other factor, I need to have certain guardrails. But conceptually, I am of the view that it is better to have N, which is the universe, which is a far more representative of all sectors, than to force fit the R stocks basis of benchmark. Because if I'm talking about saying that having say 40 stocks, and let's say that 35% has to be financials, in some say sense I'm taking a local optima within that particular subset and trying to force fit that, which means that the signal tends to get lost quite meaningfully, in my opinion. So I'm not of the camp that my personal view is that it's better to have n to be far more representative of all sectors than to try and force fit on the basis of our basis benchmark. Quickly, and this we've spoken about. So, where I think quant can complement fundamental, clearly selling biases can get reduced. Exposure beyond market beta, clearly something that we can look at. And through feedback loops, we can assess risk at any point of time to try and see whether we need to add risk or reduce risk at any point of time. Similarly, where I think fundamentals can complement quant, clearly in terms of reputation risk is something where I think the errors of commission can be reduced quite meaningfully. Persistence of holdings, which I said that it's important to give companies time in the portfolios to do their thing. And therefore, I would think that using fundamental, again, I'm not talking of discretion, saying that, okay, this stock within these 40 stocks, I'll give more time. But using a code, using algos to do the same, but bases the insight of fundamental or the behavioral aspects rather than anything else. And lastly, when does wisdom of crowd translate to meaning of crowds? It's very important when not to harvest the signal. And that is where I think fundamental hat can actually help quite meaningfully when it comes to quant investing. So I'll kind of stop here. I'm a strong proponent of this view that man plus machine is greater than man or machine. And I think that this is at least our view that how quant is likely to get the benefit of both these worlds, of both fundamental research as well as quant research. I'll kind of stop here and happy to take on any questions from you, Anish, or from the audience. Thank you.
Thanks. Thanks a lot, Harish. I think very, very insightful. I think with every talk that you give, a lot more insights keep coming in, keep adding, to the insights that you already shared. But like you said, maybe we'll talk about that slide 12 a little bit. That was quite intriguing, which was the random simulation percentile and
Sure.
the and the weighing schema where you know I've also we've done some work on this and people want to complicate this a little bit sometimes. So one question is whether one is your starting out position, whether you want to keep it equal weight or whether you want to do it based on volatility, so risk based. And the also at the time of a rebalance, do you want to sort of bring the weight back to its equal weight, its previous weight, or do you want to retain it so that it becomes a large part of it? So there's
Yeah,
a trade-off between risk management and
sure.
wanting to harvest the whole thing.
Right. So I think at least as professional money managers, our focus is to reduce churn without meaningfully losing signal. So because obviously the scale that we are talking about is in thousands of crores, and therefore I think churn management becomes quite paramount for us. And therefore, I would say that to your second question, at least my personal view is that it's better to let it run to whatever be the new weights that comes through, rather than bring it back to the original weights, etc. Unless of course the signal itself seems to suggest that we need to have a completely new thing. So I would say that so obviously we have some guardrails that we shouldn't exceed. I mean, the no position should become so large, etc. But the thinking is that you would want to kind of the trade-off is more on churn rather than wanting to be a purist when it comes to rebalancing. On the first question as to whether pure equal weighting or low volatility weighting, etc., works. Again, it depends from strategy to strategy. I think for most strategies, equal weighting is a very good idea. Even if I would think, even on the fundamental side, I would say equal weighting of active risk or equal weighting of active share is possibly a good concept, given the heavy top heavy nature of various benchmarks. We can't really go equal weight, or we fear going equal weight, let me put it that way, as a realist. But I would say that active share equal weighting is a good idea. um, um, though I mean, we definitely have seen an experience of low volatility equal weighting, in the sense that you keep equal weight as a primary construct, and with the equal weight you have a skew, plus or minus, or say plus or minus 50% on either side, so that it doesn't become too top heavy or too skewed because of the low volatility. It still retains most of its equal weight, but you have some benefit of the low volatility signal also coming through. And clearly that does improve the overall sharp. More than anything else, it improves the overall experience to the investor, given the fact that they tend to experience lesser BP or lesser volatility. And therefore, I think equal weight or equal weight complemented with low volatility as an additional layer is something that we think can add value.
Right, right. Great. There are some other questions that are coming up. One is on the reputational risk that you spoke about, and then some guardrails in terms of forensic screeners. Of course, fundamental investors do a lot more due diligence, and now, where do you draw the line again? Let's talk from the point of view of a quant investor, because the last 2 years, 2.5 years, there's been a rally in a number of sectors and stocks, which many fundamental and based investors wary about reputational risk would have clearly missed out on.
Yeah,
So how do you again balance that part out, that okay, you don't want to miss out on something, because these and also cycles, I think, in my opinion, I don't know what you think, have become very short even in terms of sector rotation as well as in terms of factor exposure.
absolutely.
So by the time you make up your mind, sometimes
Trade is
the
done.
do is almost done. So
Right. So, see, our thinking is that, again, see, when we are talking about quant, we can't make it discretionary. It's not that, I can say that, this is a stock that is a problem, because it then brings in survivorship bias in all your back test. I mean, I'm just giving a name, let's say Reliance Infrastructure or ADA. I mean, again,
yeah,
I'm just giving as a reference point because most of them believe it. Or let's say Jet Airways, even more
yeah,
easier,
yeah.
because it's
Or the Ranbaxy group long time ago also.
whatever bit. Okay, but if I were to say that it is a bad name and I wouldn't do it, the reality is in 2005 or 7 or whatever, it need not necessarily have been a bad name. The time frames, the context, everything is different, and therefore you wouldn't want to. If I'm removing today, I'm getting the benefit of survivorship bias in my back test, which,
Right.
as it is, obviously a lot of us have our own beef about only using backtest as the primary way of tom-tomming our strategies. But the reality is that you don't want to bring in that creep. So I'm not of the camp that we should say that okay, we can discretionarily pull out what it is. But we can definitely use the benefit of fundamental investing in, I would say, two or three different approaches that we've at least tried. One is, using forensic tools that can help eliminate through algos, right? So, I mean, a commonly used thing that we use at is the Benford's law, wherein we run all the statements of accounts on the Benford's law, and you get a series of gray. I mean, there's no black and white, right? You know that there are some names which do appear manipulated in terms of how their overall number of various integers are starting to stack up against the law, and therefore you think that okay, it could be a red flag. So that could be one. The second thing that we look at is the behavior of the past. So and I think that's a lot more credible, because market has infinite wisdom, right? And if for example a stock has fallen by 75-80%, and it in a short span of time it again comes to the top, Okay. Typical behavioral of investors who would be scarred by such huge erosion of wealth, for it to again come on top of the signal, would mean that it is more likely to be manipulated than otherwise. Of course, there can always be exceptions. I'm not saying that, but at least it's a rule-based way in which you can try and reduce these reputation risks. The other thing that we have also published on is basis past behavior of compounding, right? So there are these set of investors, and that's a blog that I've written on disgruntled investors in companies and
Yeah.
happy shareholders, right? So basis their past track record over the last 10, 15, 20 years, you are able to identify companies which are either disgruntled companies, in the sense that they have a lot of investor base which is disgruntled, because they have made subpar or negative returns for majority of the time frame. And then there are these set of companies which are more on the happy side, right? And our thinking is that, with the disgruntled share set of companies, you would want to be a little more sharp in terms of getting the signal. You wouldn't want to persist with that company should the signal not be really of the topmost quintile or so. And therefore, if it falls off that, you would want to get off. Whereas for other companies, even if they are, say, in the middling path, you may want to give it some more time for it to get the benefit of compounding of time. So these are the two, three different ways in which we try and codify these. And finally, obviously, it also helps that, in some cases, our access and channel checks, etc. I'm saying in terms of live portfolios, you would want to kind of do that. But from a pure quant thing, I would say that these are the three, four different ways in which we can try and codify, so that we have less of those mishaps, which are more. I mean, when we look at portfolios, then they look like any fundamental driven investor would have invested in these names than
Right.
otherwise.
So, we have this question from a LinkedIn viewer saying that the selection, allocation, and timing decision between fundamental and systematic quant investments are very different. So, how does a investor choose between the fundamental and quant characteristics across the cross section of the universe? I think maybe he's trying to ask whether, if you want to invest in a fundamental strategy versus a quant strategy, how does he or she evaluate between the two?
So I think this is right up your alley, Anish, than mine. But see, at the end of the day, like I said, among those three dimensions that I spoke about, of insight, repeatability, and cost, I think the final decision has to be a interplay of each of these factors, right? Um, I am of the view that there is definitely a lot of merit in proprietary insights. Because markets, I mean, while for most part it is reasonably, you can say, efficient, but there definitely is opportunity to try and get higher than average returns. Again, it may not be a lot. Again, I'm not saying that this is in Mars and
Yeah.
that is Venus, but then can we endeavor to get that, and are there strategies and are there track records that give that evidence? So rolling returns, how often are the hit rates, etc. More importantly, how much percentage of the portfolio is in the better half vis-a-vis the other half. I think all of those aspects are far more important than looking at only the point to point or the past track record, which is what most investors typically focus on because that's the easier thing. And which is where I would say one will get it. Um, so I would say that a good quant strategy. Again, I may upset a lot of quant people out here, and which is what I guess the idea of the talk was.
Yeah,
I
yeah.
think quant investing is a good satellite position in a portfolio. That's my view,
Yeah.
because of the high active share it can get. Right, so you can have a core portfolio. It could be, if you are a pure index investor, etc. Go for a pure plain vanilla core index as your thing, or a good two, three actively managed funds. Whatever you have greater focus on, that is the core. And you can then get the satellite through quant strategies, because many of them are, you can say, reasonably. If you look at portfolio, they are very different from pure fundamental investors. I wouldn't think that, again, I could be wrong. I wouldn't want to put a whole bunch of the core money in quant, primarily because I think Indian markets, in my view, aren't deep enough to handle that kind of money. More than anything else, I'm not saying that quant algos or the quant signals are bad, but to handle the money that we are doing in public equities, we are managing 17, 18 lakh crores on the mutual fund side. I would think
Yeah,
even if 1% of that comes into the quant side, it was going to cause quite a havoc. Given our current evolution, again,
correct.
uh, markets will evolve, all of that will happen. But at this point of time, can I think of, say, 10% of that, say 1 lakh crores going into quant oriented strategies? At least my gut feel says that, we'll ourselves impact the overall signal by the flows that we'll bring in. So I would say it's a good satellite position, um, uh, in terms of quant, and the core to be a fundamental stroke passive, whatever you are in the camp of. I'm not getting into the active passive debate that.
Yeah, and particularly on the rebalance, I think that's where most of the issues will come up, and your tracking error will start,
Yeah.
going up, until we start getting more liquidity or some other, innovations or some other kind of instruments start coming in. It's going to be hard to be pure systematic, for a large
Absolutely.
fund house.
Right. The other positive, and unlike, say, a public indice based quant, it could be any of these factors, etc. I think the benefit of running a proprietary quant is also
Yeah,
that we can actually know the portfolio maybe 10, 15, 20 days, provided your signal is basis that. I'm not saying that
yeah,
everybody will get to know that, etc. It depends on how they have constructed the signal, which means that, in many of the private quant, you actually have got a 10, 15, 20 days to execute your strategies, which means that the ability to handle greater capacities can go up without necessarily impacting at that. And of course, if everybody focuses on, say, the quarter end as the only date in which you're going to
yeah,
rebalance, then that itself will bring its own series of anomalies, right? So which is where I would say that private quant scores over public quant. They have their pros and cons. I'm not saying that one is entirely loaded up on one side, but the ability to handle more capacities, the ability to have proprietary insights, even within quant, I would say a lot more can happen on the private quant side than necessarily on the public based index quant, if I can use that.
correct. Yeah, I'm mindful a little bit of the time, so I'll ask you the last few couple of questions. But one thing that, as quants, we talk about is, it takes away the emotional bias, or it takes away the emotion out of it. But my experience, so far, has been a little different. That it sort of takes the, bit of emotion. It brings in more discipline, but I don't think it takes away the emotion at all. It in fact, sometimes it's far more difficult for me to submit to a machine, to an algorithm. There's something human about not submit. I mean, we are not comfortable with autonomous cars or autopilot. If you know that your pilot was sleeping in the plane,
Right.
I don't know how comfortable. Although we are comfortable with that now, but so what is your view on that in terms of, how psychologically difficult it is to run a quant?
And even more psychologically difficult for someone like me who's running both. I mean, so
Yeah, it'll be.
right,
Uh,
on the fundamental side, you've got a particular view, and what the quant is saying based on the wisdom of the crowds, etc. It's giving a completely, you can say, an orthogonal view, and yet you have to be dispassionate in wearing both the hats. And I'm sure that the creep is going to come through. It's not that, but I can give my own experience, for example, in the asset allocation products that we managed, right? During COVID, I think it was only due to the quant and the model that we did what we did, which was to go fully invested in the peak of COVID. Of course, it's all hindsight and luck that markets bounce back so quickly, etc. I don't think any model that we develop is not about AI or trying to figure out what will perform the best. I think at least I'm not of the camp that any forward-looking models, etc., in terms of timing, etc., makes sense. It's more of a profiling of risk, wherein you profile risk, and then basis that you assess what the odds are, and on that basis you take. So it has to be a probabilistic kind of a decision making. And because of the positive experience that we've seen, because of that, I think it has helped us, saying that it makes a lot of sense to be disciplined by that. But I would say that the bigger worry is going to be that, as a fundamental shop, let's say, as a fundamental PM, let's say a stock comes and gives a particular news flow, or a regulatory action comes through, etc. Typically I mean, I'm not saying it's a good thing to react always, but sometimes you will have to react, right? Now, basis pure quant, you can always say that on rebalance date, basis whatever the signal, you will take that call. But the reality could be that sometimes it does help to take the call, because there is no way that the model is going to know what is the change in regulation, what is the new environment that is coming through. And therefore it makes more sense to be a man plus machine, all the more even within quant. Of course, one should use it sparingly. You can't be using it every second day and third
Yeah,
day and justifying it. I guess it's all the balance of how you look at it. But I would say maybe once in 6 months or something, if such a decision comes through, at that point of time, I would say that being a purist may actually be negative. It's better to realize that the model wouldn't know that, and to move it into Nifty, or move it into the market. You don't have to go into cash or any of those
right.
things, but at least move into the market beta, so that at least you're getting something. But that's about it. You're not further compounding the mistake by going into something else. So I think those nuances come with experience, is my sense.
Yeah, I think this question is something you already answered in some way, that man plus machine over man or machine. But Karthik is asking, as the markets become more efficient, won't it be difficult for fundamental investing to generate alpha vis-a-vis fundamental plus quant investing?
Yeah, I would like to believe so. But the reality is, I don't think any of us know. I mean,
Yeah,
I mean, I'm sure a particular approach, if whoever they do it very well from first principles, they will have a good chance of succeeding. Um, where I would think that fundamental and quant, and which we have outlined, I think over the course of the last hour or so,
yeah,
is clearly in terms of getting a repeatability more than anything else. And in many ways, sometimes a lot of these things, when it's acting like a mirror to a lot of our decision making, and you can actually make a lot of inefficiencies that we've been historically doing, wearing the fundamental lens, actually get questioned. And obviously it's a function of how open you are as a person to try and embrace these difficult questions, because obviously when you're doing well, it feels that you've got the lucky charm or whatever you have. But when
correct.
you have these provoked questions come from by the model, and to see that what you could have achieved, that is when I guess a lot of us have to really introspect. So I would think that fundamental and quant together will be a far more powerful way of doing it. But that could just be my bias, because that's the path that I have chosen.
Right. No, it will be like, so many of the quants or trend followers like Paul Tudor Jones or Cliff Asness, they have gone through long stretches, and sometimes they say that sometimes you just come and think that it's so easy to make money, and on other days you walk in and you feel like such an idiot that you and what have I been doing all these years. So the market has a way of humbling people. The moment you think you found the key, there just changes the lock. So, Harish, what would you say to Harish 20 years ago if he was entering the investing world today? What would your advice be to the young investors who
I,
want to
I
make a
would
career
I
in
would
fund
definitely say learn Python. 20 years back, or any of these coding thing. But
yeah,
again, I don't think it's a skill. I'm saying as a fresher, yes, it's a good skill to have.
right.
It's not to
Is
say
it the
that
new Excel? Like, is it as default as Excel?
Yeah, and any which case,
Or
with
yeah,
all
right,
these tools that are coming through, I don't even think we need any of those tools. Also, I mean,
right,
what matters is the algo or the brains behind that, rather than
yeah,
the most efficient way in which to code. Is my view. I've been
correct,
a coder in my past avatar at Infosys. Again, 24 years back, but that's a different
right,
story altogether.
right,
But so I have gone through four light bulb moments in my 18 19 years, right? And for each person it's going to be different at different points of time.
correct.
I mean, I don't want to bore you with what those four moments are,
At some
but
point in time, I'd like to hear
yeah,
those.
but clearly the latest light bulb moment about 4 5 years ago is to use quant plus fundamentals, right? And
During COVID, that you said that you.
yeah, or maybe even before, maybe 1 2 years before that. And during COVID, of course, it finally got rolling in a very meaningful way. But more than anything else, I would say that there are two things that really have helped me, and I'm glad that I learned these from practitioners 20 years ago. First was, one of my profs said that you have to you have to look at businesses from the longevity point of view. I mean, there was only one assignment in his course, which was that assume that you made a lot of money at 20 till 40. At 40 you took sannyas. For the next 20 years you were in Himalayas, and you have to identify one company where you would put in all your savings, and then what you will take it out at year 60. Now, the beauty of this case or study or this thing was to impress upon us the importance of longevity more than anything else in that compounding machine of wealth creation. Right? More than focusing on the fad, etc., was that. The second thing that he focused on was clearly that, and which I covered in today's talk, is that you have to decide with improper or insufficient information. You have to pull the trigger at 65 70% of information. So till 50, Google Zindabad, but from 50 to 65 70, you have to arrive at a way in which you are going to get to that decision point. And one of the ways in which he would say is key, imagine you have got the management at your beck and call once, and you can ask them only 5 questions that will get you from 50 to 65 70%. What would those 5 questions be? And again, at that point of time, 20 years ago, I never understood the importance of all of those things. But
Right,
with cycles and with time, I have realized that those were the most important lessons that I have learned. Other two things that I would quickly add on is, one is to have a journal. It's very important to write our investment thesis, two-liner, three-liner, as and when we make that decision, so that we know exactly how it played out, unbiased view, right? The fourth thing I would say is that make a lot of mistakes, make a lot of small mistakes. Hopefully, don't repeat them, because this journey of self-actualization or self-learning comes only when you make mistakes. There is
right,
no way in which one can say that this is the path that I think you should do it. You will all have to find your own paths, and most of the paths, I was glad that I made most of my mistakes very early on in my career, which was a blessing in disguise, which meant that I could get onto the learning path a lot more quicker. I would like to believe so, and which is what I would urge most people who are just starting out now.
okay, excellent. Any favorite books or any books that you think that folks should read? It could be both related to investing, not related to investing. I know you shared one link a few days ago.
Yeah.
It's bookmark. I bookmarked that. I still have to read it. But
Yeah, I think that book is, to my mind, the best book I would encourage everyone to look through, especially from investing or from the beauty of capitalism and the beauty of market making, which is basically the economic organization of a POW camp. It's written by actual prisoner of war in 1945. It's a 14-page read,
right,
very, very small. So that is one. Um, I would say that Capital Returns is a
yeah,
fantastic book
it's
that's out
yeah,
there. So that I would say reads well. Similarly, on the personal level, I would say books like Yuganta by Iravati Karve, which is basically about the Mahabharata, that has had a very deep impression on me. Another book that I think from an investment point of view, though not a lot of people agree to it, is Creativity Inc. I'm quite fascinated by how Pixar, which is in the creative business, has got
Yeah.
hit after hit, and our business is a lot like that, right? It's so probabilistic in its outcomes, and so how do you control all of these variables to still manage creativity, get diversity of opinion, and yet have a method in the madness? So I would say these three four books is what I would
Yeah, no, Creativity Inc. is also one of my favorite books. I mean, it gave great insight into the working of the mind of Steve Jobs as well as the organization.
absolutely.
That they come up with the stories and how often we as quants or as fundamental investors, you need to have a graveyard of ideas, the things that you've tested out and you just have to jump.
Yes.
Because you keep on, you have to sometimes, like, if, even Cliff Aston says that, if you don't have a crisis of confidence once in a while, you're not you're
You will
not
not push yourself.
yeah, you'll not push yourself, and you just want, even a guy who's done his PhD under gene pharmacy sometimes, do I is this all data mined, is this, all, am I just having a stroke of luck or something like that? But the last question is, what are you watching on OTT now, and what's on your playlist?
OTT, nothing. I don't think
No.
I've watched in the last 6 months any new series. So, playlist, of course, I'm a big buff of classic rock. So, at any point
Okay.
of time, you will see Def Leppard, Led Zepp. It's a mix of all of that. Sometimes, in a more reflective mood, it would be, I would say, instrumental music. It could be both Indian, Carnatic, or it could be any kind of Western classical. Again, I'm not a connoisseur of any of these, but
Right.
it just
No,
puts me in a reflective mood, and so those would be what you will see in most of my playlist.
great. Uh, Thanks a lot, Harish. I think it was great having you here today, and look forward to having many more conversations with you, and having many more discussions. And this journey, I think, has just started in India, maybe, and I think we're lucky to be a part of it. So, thanks a
Absolutely.
lot for coming on, and look forward to
and
speaking with you
and
next.
sorry for all the tech goof up.
No, no, I don't
Maybe
think
a
that.
wrong day for all of that to happen,
No,
but
but you took the time and you
maybe
came. So it's
yeah,
great.
maybe we'll try one more episode at a later time, maybe of a completely different nature, uh,
Definitely.
to try and converse. Thank you so much, Anish. Always a pleasure. Thank you.
All right. Thanks.